Happy Monday and welcome to Yahoo Finance Live. I'm Julie Hyman, that's Josh Lifton. We're here at the New York Stock Exchange bringing you the top three stories at 3 p.m. We begin with this, a mixed picture on electric vehicle deliveries. Tesla reporting weaker than expected numbers for the third quarter as factory upgrades force some production to be halted in the last 3 months. Now, some analysts are optimistic the deliveries will rebound, especially with an updated Model 3 sedan rolling off the line. On the other hand, Rivian surprising Wall Street with better than expected numbers. Deliveries jumping more than 140% from a year ago, now topping 15,000. But that plus an upgrade, not enough to lift the stock today. We'll take a closer look at the EV race coming up.
And stocks are coming off their worst month of the year, with the most of the Magnificent Seven suffering sharp declines in September. We're looking at the mega cap names and what's in store as we gear up for the fourth quarter. Plus, UBS reiterating Amazon at a buy. We're going to speak with the analyst who made that call, and we'll explain just how much ads on Prime Video will add to Amazon's top line.
And Sam Bankman-Fried's fraud trial gets underway tomorrow. The face of the crypto boom and collapse also faces charges of money laundering, to all of which he has pleaded not guilty. We get a legal expert's take on the case and what to expect when key members of SBF's inner circle testify, including his former girlfriend and Alameda Research CEO, Caroline Ellison. Let's take a look now at the latest market action. We've got a mixed picture for stocks today to kick off the quarter and the month. The Nasdaq was up, earlier, much more. Now it's given up a lot of those gains. It's only up not even 1/10%. The S&P, in the meantime, losing about 0.5%, and the Dow off by 200 points or so, down 0.6%. Part of the tail wagging the dog, so to speak, recently has been bond yields. Even though bond yields have been higher today, the 10-year yield once again climbing on some better than estimated economic data, this time on manufacturing. Those yields at 4.68%, which have been problematic for tech stocks in recent days, not as problematic today, interestingly enough, but we are seeing other areas like utility stocks and real estate get hit.
And Ethereum futures exchange traded funds making their U.S. debut today. ProShares, VanEck, and Bitwise all launching their products. This coming as Grayscale files for approval to convert its Ethereum trust into a spot Ethereum exchange traded fund. So this is interesting, Joy. So we've had, of course, Bitcoin futures ETFs for a while now. Of course, those made their debut during a very different time in the world of crypto. Bitcoin was a lot higher. Now we have these sort of Ethereum-themed ETFs. I'll be very interested in what demand is like. And to the extent there is demand, where does it come from? Does it come from retail investors, Julie, Josh, friends and family? Or is this, to the extent, again, that we see it, is it more of a financial advisor product? This is something they want to buy their customers?
I'm not clear on the answers to any of these questions, right? Because on the one hand, you have the SBF trial that is set to begin. That, defenders of crypto would say, well, you get fraud in any asset class. This is not unique to crypto. Critics of crypto would say that there are qualities of cryptocurrencies that make it especially susceptible to fraud, in part, one of them being that it is not as regulated as other types of asset classes. So that debate sort of rages on in the background, even as we get approval and beginning of trading of these new products. So it's kind of an interesting time, if you will. At the same time, we see Bitcoin up today, right? We see some buying, again, even as the SBF trial is set to begin. Ethereum, though, is trading lower, so all of these products are also under pressure in today's session. So it's unclear exactly what the situation will bring. I should also mention real quickly, Grayscale Investments is also now applied to have its Ethereum trust converted into an ETF. And of course, it's been on that similar quest with its Bitcoin ETF. And,
Bitcoin, we just showed there, so near 28,000. It has rebounded strongly, but of course, way off that record of 69,000. I thought it was very interesting, too, Julie, just what venture investors are doing right now. So these are obviously the men and women that are writing all those checks to those private companies. And this, courtesy of Bloomberg, VC deals targeting cryptocurrency and blockchain projects have shrunk to about $7 billion in total this year. That is about, Julie, a quarter of the full year tally in each of 2021 and 2022. So bottom line, VCs tightening their purse strings a bit here.
Yeah, again, you have that at the same time that the likes of Coinbase are in DC still really taking their case to regulators
So much
all of
enthusiasm
these-
for those spot Bitcoin ETFs, right? I mean, that is
From
really
somebody.
from some, at least the crypto fans, right, are
I
waiting.
guess so, such as they are at this point. Well, let's dig more into what's going on in the markets today more broadly. It's the first trading day, of course, of the fourth quarter. Stocks are mostly lower, despite lawmakers averting a government shutdown for the time being, at least. Meanwhile, Federal Reserve Vice Chair for Supervision Michael Barr warning that the central bank should proceed carefully on monetary policy. And he says the biggest issue for the Fed is going to be how long interest rates stay at these elevated levels. Let's talk about what all of this means for markets for the remainder of the year. Joining us now is David Sequeira, Morningstar Chief U.S. Market Strategist, and Gus Fauché, PNC Chief Economist. David, I want to start with you here. Coming off of a lousy month for stocks here, a little bit of a relief perhaps that the government shutdown is not happening, at least not yet. How should investors be setting up here till the end of the year?
Well, we think the market right now after this pullback is about 8% undervalued. It's interesting, according to our valuations, the market just barely touched fair value at the end of July. We noted at that point in time, we thought it was a good time to start locking in some profits, selling those stocks that became overvalued and overextended. And now I think a lot of stocks are now becoming much more attractive at this point. And in fact, the growth category, in our view, has sold off enough that we're now moving from an underweight at the end of last quarter now back to a market weight.
And Gus, as the economist today on the panel, I'm interested to get your take. Listen, we avoided the government shutdown, averted that, Gus, but plenty other risks for the economy. We have a lot of folks, Gus, who come on, CEOs, economists, strategists, they still believe we're going to hit this soft landing. So return to that 2% Fed target, but without the economic downturn. On the other hand, Gus, we had guests on Yahoo Finance who say not so fast. Sticking that landing, they'll say that soft landing, that's rare and tricky. Where are you on your outlook? Are you in that soft landing camp?
No, I'm in a mild recession camp starting sometime in the late winter, early spring of next year. We've had an incredible tightening in monetary policy. Both short-term and long-term interest rates have gone up dramatically over the past couple of years. We now have the hit from the auto strike. We have the end of the student loan deferments. Oil prices are higher. That's going to be a drag on consumers. So, there's still probably a 40% chance we get out of this with the soft landing. But I think the most likely outcome is a mild recession starting in the first half of next year and lasting about 6 months or so.
And David, when you hear, well, first of all, are you on the same page, I guess, with Gus when it comes to that economic outlook? And then talk to me about how the Fed plays into this. Right now, if you look at Fed funds futures, they're pricing in about a 25% chance or so that we could get another interest rate increase. If indeed we're headed to recession, what are the implications of that?
Yeah, we think the Fed is actually done for this monetary tightening policy cycle. We think their next move will actually be not to raise rates again, but actually to start cutting rates as soon as possibly early next year. So in our view, we're looking at very strong GDP here in the third quarter. I think our current view is about 3.9%. We are looking for GDP to start softening over the next couple of quarters. So in the fourth quarter, we're only looking for about a 2% GDP rate. And for beginning of next year, a little bit under 1% in first quarter, and then getting pretty close to stall speed, but still above, negative in the second quarter. And then looking for the economy to start, recovering thereafter. Now, we also do think that inflation will continue to keep moderating. So we think that a combination of the slowing economy with inflation moderating will actually give the Fed the room that it needs to actually start cutting rates next year.
And Gus, I'm interested to get your response there. You agree with that call? You think the Fed is done with this rate hiking campaign? You expect them to pause in November? And when do you, just as importantly, Gus, when do you think they can actually start cutting and by how much?
Well, I do think that they're done. I think we are seeing inflation move to the 2% objective. We have seen the labor market cool off significantly, and I think the unemployment rate will move higher through the rest of 2023 and into 2024. That being said, I foresee rate cuts sometime probably in the second quarter of 2024, but that's because the economy is going to be in recession, we think. That will cause inflation to slow more dramatically. We'll move from job gains to job losses. We'll see the unemployment rate rise more quickly. And that means that the Fed will start to cut rates sometime in the spring of next year in order to combat a recession.
Gus, I want to zero in on the economic data that we got today for just a second, because we got a measure of factory activity or manufacturing that did contract, but it didn't contract by as much as estimated, and it contracted by the least, in nearly a year's time. Are we seeing an inflection point for manufacturing at least?
I don't think so. I mean, interest rates are still very, very high. Tighter monetary policy works on the economy with a lag. I think that right now the Fed funds rate is contractionary. It's weighing on economic activity. So I do expect that we'll see some more softness in manufacturing. And then don't forget, we've seen mortgage rates move significantly higher over the past month or so. So housing related manufacturing is going to slow through the rest of this year and then into 2024 as well.
And David, turning back to just traders, investors, what they're looking for, as you mentioned, I think earlier, we came off a tough September there. Market slid nearly 5%. Worst monthly performance, I believe, since December. Some bulls are looking ahead to earnings season. That's going to be here before you know it, David. In just a couple of weeks, that's going to kick off. And some bulls argue that's the catalyst that could get us back on track here. Do you buy that? What are you looking for in this earnings season?
Well, I think third quarter numbers themselves are actually going to look very well. So I'm not concerned about looking backward at third quarter earnings. I'm much more concerned about the body language and the guidance that we're going to get from companies going forward. I do think there could be some disappointment as far as what fourth quarter earnings could be. So we could still see more volatility yet to come later this month. But I do think with the market trading off as much as it has, a lot of that is already probably priced in. So maybe a little bit more downward momentum, but that's actually probably a good time for investors to start moving back into some overweight positions, especially in some of these sectors that have really gotten hit hard over the last week. I think you mentioned utilities earlier. That's one where it was a sector we thought was overvalued coming into the year. It's sold off so much at this point. It's really starting to get much more attractive, seeing a lot more 4-star rated stocks that we think are undervalued at this point in that sector. Same thing with real estate. It's another area that's been hit very hard. Personally, I'd still steer clear of the office space. But a lot of the other real estate areas, I think, have just gotten pulled down too much at this point.
It's interesting. We're going to talk much more about commercial real estate and office real estate later in the show. But David, so it's interesting that you're looking at these areas, which presumably have been hit because of the increases we've been seeing at rates. Does that imply that the effect of higher rates has adequately been priced into something like utilities or real estate ex-office?
We think so. So in addition to the Fed cutting rates next year, when we start looking at the longer end of the curve, we think the long rates like the 10-year are probably pretty close to peaking out at this point in time. I know our U.S. economics team is forecasting, I think, a 3.25% 10-year by the end of next year. So again, as interest rates start coming back down over the next 12 to 18 months, certainly will be a good tailwind for both utilities and real estate.
All right, David Sekera, Morningstar Chief U.S. Market Strategist, and Gus Fauché, PNC Chief Economist. Thank you so much, gentlemen. That was great.
Thank you.
And shares of Instacart falling today, down in the red on a report from The Information saying the banks that underwrote the company's IPO see slower revenue growth and lower profits than it reported in the first half of the year. Stock also moving on a hold rating from Gordon Haskett, the analyst citing a number of headwinds for the grocery delivery company. So this one is another interesting story, Julie, because when they made their debut, there were some positives. It was a decent bottom line, right? A lot of tech companies, as we know, when they make their debut, they don't necessarily show that. But on the other hand, growth had slowed. And Instacart would say, well, listen, that's tough comps. That's macro headwinds like inflation. Analysts are saying that probably also is competition sneaking up on you. And Instacart has a lot of it.
It does have a lot of it. I mean, you have to wonder at what point are some of these companies that did come public wishing they hadn't? I mean, by the same token, Instacart presumably needed to tap the public markets to get access to capital here. So I don't know. I mean, if you look at how it's performed, it's got 4 holds on it so far.
Not a lot of enthusiasm.
No sells.
You also kind of wonder, to the extent that we we were just talking to economists, the extent that you start getting nervous about what the consumer might be feeling, the jitters they start feeling, you would think it's possible, of course, if they start getting nervous, a grocery delivery app could be one of the first things to go.
It's expensive.
Yeah,
get
we
your
both tried it.
Delivered. I mean, I like grocery shopping myself. I'm one of those weird people who likes to go to the store
Nothing weird about that.
and pick out stuff myself.
And
rather, you know, I like to go to the farmer's market. I went this weekend. It makes me very happy. I'm one of those. But but to your point, if people are cutting back, I think the question is when and whether we will see higher income consumers cut back and decide where to redeploy their money. So that's really the big question here. We've seen it on the lower end.
Yep.
The higher end is what would affect the likes of Instacart. All right, let's take a look at some other movers here. We've got shares of Kellogg trading lower on the day. That's after the 117-year-old maker of Pringles and Frosted Flakes split into two companies. Things like Pringles, Pop-Tarts, Cheez-Its are going to operate under the Novella brand, which is going to retain the K ticker that has been Kellogg's. Cereals like Fruit Loops and Special K will operate under the name WK Kellogg. KLG is the ticker there on the New York Stock Exchange, which is for the founder of the company. I like Novella because it rhymes with telenovela. I don't know. I think it's...
That's a good reason to buy,
I think it's kind of fun here.
It rhymes, it must be true.
But it is interesting that you were seeing this this spinoff here. And our Brian Sozzi, who talked to the CEO of, I think now, Novella today, also cited some analyst commentary from Jefferies. Wait, what am I saying? Kellanova? I'm saying it wrong.
Sounded right to me.
Because I'm saying telenovela.
Sounded
It's
fine to me.
Kellanova, not Kellanova. Whoops. All right. Anyway, so the analyst over at Jefferies is saying that they're not necessarily that excited, I think, about the...
Well, the strategy, I guess, is we're going to spin off the cereals. We're going to spin off the Frosted Flakes and the Fruit Loops, which I love both. No foul there. But why? And I guess the idea is that once we do that, that performance, the business, that division will just perform better. And I guess I get it because in theory, so you're more focused, you're narrow, you're not going to be distracted by the Pringles anymore, the snacks. But it looks like at least investors initially here a little skeptical.
It seems that way. And then there's another spinoff I just wanted to quickly mention today. Danaher, the big tool and testing systems maker, is also doing a spinoff on a related note here. So Danaher is spinning off Veralta, which is its environmental and applied solutions segment. Hopefully I've said that one right. VLTO. It's faring a little bit better. That is the spinoff is. It's up about 0.5%. Danaher still down about 3.25% today. So a lot of attempts to unlock value here.
A lot of moves. And lastly, let's look at shares of NVIDIA trading higher today. It's after Goldman Sachs added the stock to its conviction buy list. Goldman attributing the move to NVIDIA's position within the AI race. Nice tack on there, 2%. NVIDIA actually had a tougher September, but of course this one has been a rocket ship. It's still up more than 100% this year. And what analysts seem to like here, they point out the competitive moat, the broadening demand in the data center, and they think perhaps further buybacks. Of course, when talking to NVIDIA too is when you look at that chart, no surprise, when you see that kind of chart, it has attracted a lot of competition too. That'll be fun to watch. AMD, Intel, the big cloud computing giants, the Amazons and Googles, all also developing their own chips. So
they are developing
fight
their
to watch.
Chips. I mean, the price target on this is 605 because obviously we know that NVIDIA has already had a lot of upside. It's already on a lot of, buy lists across the street. Goldman putting it on its conviction buy list is just like a little cherry on top or a little further push
we love
here.
it even more.
Yeah, I guess so. I mean, but when you've seen the stock go up 265% over the past year, and then seeing that upside to 605, it again just emphasizes the view on the street that there's NVIDIA and there's everyone else when it comes to AI.
Very good one. 95% of analysts covering this name still rated to buy here.
Yeah, it's pretty.
A lot of love for NVIDIA.
We're just getting started here. Yes, there is on Yahoo Finance Live. Coming up, shifting gears, shares of Tesla. They've been bouncing around today. Right now, they're back in the red after missing on delivery estimates for the third quarter. We're going to break down what it means for the EV maker. And SBF on trial. Sam Bankman-Fried's trial surrounding the largest crypto collapse in history. It begins tomorrow. We'll get insight into how prosecutors are approaching the case. Plus, are you ready to unretire? We'll tell you about the return to work trend that's flying under the radar. All that and more when Yahoo Finance returns. Let's do a quick check of the markets now, sponsored by Tasty Trade. We're still looking at a mixed picture here. The Nasdaq gaining a little bit of steam here, up a fifth of 1% now. The S&P off by a third. The Dow off by about a half of 1%, as we have been seeing weakness here today in some of the interest rate sensitive groups within the S&P, at least. Energy stocks also trading lower on the day. And let's also take a look at the VIX here, the volatility index, as we see this kind of meh trading day. Got a little bit of pop in the VIX, up to 18.3, but still not seeing out of control volatility. That would be closer to the likes of a 20 handle on the VIX. And a mixed picture on electric vehicle deliveries. Tesla shipping more than 435,000 vehicles last quarter, but that was weaker than analysts had anticipated. Factory upgrades forcing some production to be halted in the last 3 months. Despite the miss, Tesla maintaining its full year forecast for deliveries at around 1.8 million. Also, Rivian surprising Wall Street with better than expected numbers. Deliveries there jumping more than 140% from a year ago, now topping 15,000. It still has a long way to go to catch up with Tesla or some of the other truck makers that are out there. Rivian, interestingly, today is down 3%. There seemed to be some concern over that company's forecast. Perhaps that's what's going on here. The full year delivery outlook missing analyst estimates. And also interesting that, I mean, there was a lot of anticipation that Tesla's deliveries were not going to be great.
Yeah.
So perhaps just not a huge surprise here that it did come out and do that.
Exactly right. I mean, I think on Tesla, there wasn't high hopes here, high expectations, because there were these downtimes at their factories, specifically Austin and Shanghai. As you noted, importantly, guidance, they're holding steady there. 2023 volume target still around 1.8 million vehicles, so that's unchanged. The team at Wedbush actually thinks the factory downtimes likely means, by their math, 20,000 units shift to Q4, but obviously we'll find out when they report earnings on October 18th.
Yeah, one of the other themes that I've seen a lot of analysts chatter about today is the margin figure at Tesla. There are a lot of questions around going forward. Are we going to see a little more pricing firmness and stability when it comes to Tesla? And is that also going to have good implications for gross margins? That's one of the biggest questions for them, it feels like.
And the Cybertruck as well.
The Cybertruck, which they talked about maybe coming in the third quarter. Well, guess what?
That is
third quarter's done.
Yeah, there we go. There's your triangular shaped truck. There was the expectation for Q3. That has come and gone. So, and listen, that is very important if you're an investor, if you're a Tesla bull, because you see there on the screen, the bulls think that truck, they're counting on that as a tailwind for next year.
We'll see about that.
Are you skeptical of demand for the triangular truck? Is that what I'm picking up there?
I'm skeptical. I mean, they've had a lot of engineering issues with it, reportedly. It's a heavy truck. It's made of stainless steel. And so there are a lot of engineering issues. Aesthetically, it's not for me. But
it's not for me either. But you know what, Julie Hyman, maybe we're the outliers. We're going to find out. Maybe.
I don't know. With that price tag, I don't know how many people can afford it who would like it. But just very quickly, we also got the Chinese automakers reporting deliveries as well. When you talk about competition for Tesla, particularly in China, it's coming from the homegrown automakers. So we had Li Auto, Xpeng, and some of the others. NIO also reporting their numbers. They're all trading lower in the wake of reporting that. And, obviously a lot of attention focused on China. The Chinese markets are closed, by the way, we should mention, for a holiday week. So these guys trade in the U.S., but they're not trading in China at the moment.
And of course, there, to bring back to Tesla, we know the price-cutting game, because Elon's been very upfront about his strategy, right? Volume, even at the expense of profit margins.
Yes.
All right, moving on. We are watching oil today as well, of course. Pulling back and breaking below that $90 a barrel. Crude, though, hitting a 3-week low as a strong dollar has some investors taking profits. Joining us now is Gas Buddy Head of Petroleum Analysis. That's Patrick DeHaan. Patrick, thanks for joining us.
Good to be with you.
So, Patrick, let's start there. So some easing today for oil, but we know the price there has run up substantially, Patrick. I'm interested just to first get your 30,000 view take. Where do you think the price goes from here? Does it hit $100? That's obviously not a huge bold call at these levels, but do you think we hit 100 and move past it, or do we reverse, Patrick? What are you looking?
Well, I think the market may have some upside. I think it really is contingent on the Federal Reserve. They obviously have the threat of raising interest rates, and that certainly could stifle demand here, but it could also set a tempo for overseas as well. So I think that's why oil prices are kind of stuck in this limbo here, because the Fed has said that inflation is still rather high, and they may continue to raise interest rates maybe another one or two times. I think on the other side of the situation, though, keeping oil prices up, certainly Saudi Arabia and Russia's production cuts, and keep in mind that OPEC Plus has production cuts phased in starting in 2024. So I think global inventories are contracting. That's worrisome, but the only thing throwing cold water on that is the potential interest rate increases from the Fed. I think we do get to $100 potentially next year, if not this year, when we finally get to the point where global inventories are low enough against a backdrop of demand that will start to go up seasonally next spring.
You know, Patrick, it's Julie here. Of all the things that you think about the Fed's interest rate increases having an effect on, oil is not my first one that springs to mind because it is more of an actual supply-demand issue. Food, I guess, would be other things where it doesn't have as much of an effect. So when you look at interest rate increases, talk to me about that transmission mechanism to oil and whether it really does have that big of an impact.
Yeah, there is this cat and mouse game with oil prices and inflation rates back and forth. Obviously, energy prices are part of the reason why the Fed started raising interest rates so significantly last year. And now it's a bit of a cat and mouse game where lower energy prices, or I should say lower oil production from Saudi Arabia is acting to try and prop oil prices up. We've seen oil prices, WTI, from $65 a barrel earlier this summer all the way to $90 and touching $94 a barrel last week. So the Fed is very closely watching, and I think they're trying to balance some of OPEC's comments with comments of their own that would put downward pressure on demand if they do continue to make it expensive to borrow. Americans probably are going to feel overall pessimistic about the economy, and that could also set the tone. We've seen China economic data disappoint as well. So a lot of this now, maybe some back and forth comments on the Fed trying to keep the price of energy low by insinuating that it could raise rates progressively moving forward.
And Patrick, you mentioned how the Fed is closely watching this. You can bet the Biden administration is also closely watching. If it moved too high here, would you expect the administration to step in?
You know, I think they're watching from the sidelines very cautiously. I don't know how they would exactly weigh in the market. You know, they may have a tool in the Fed, and I don't know that they'll execute that. And certainly I don't think they would, but kind of cautiously waiting. I think, as you point out, the Biden administration's been having this kind of love-hate relationship with the oil sector, the refining sector. As prices have gone up, they've kind of insinuated and pushed the sector to produce more. Yeah, I don't know that the Biden administration has a whole lot of tools in their war chest, so to speak. Last year it was the SPR, but now with the SPR at 350 million barrels, they've started to refill it up. But, you know, this is kind of where U.S. oil producers can be incentivized to fill in the gap here, but they haven't done so. And, of course, that kind of is tied into the politics, the optics behind the Biden administration in the last couple of years.
Patrick, we've been talking about oil fundamentals generally. Let's zero in on gasoline a little bit more squarely here, because I've been seeing that the refinery maintenance season is expected to be pretty tough. A lot of capacity is going to be taken out of the market. What effect do you see that having on refined products like gasoline?
Well, it's something to keep a close eye on. And because of that maintenance, the West Coast has been really the only region of the country that's seen prices going up. Everyone else, the refinery maintenance is being offset by seasonally weak gasoline demand. Now, here in the last week, according to our data, gasoline demand is looking a little stronger, a little bit closer to what I would expect. But that's certainly a big wild card, especially for the Northeast. There's a lot of refinery turnarounds happening across the country, but the Northeast sees it very acutely because of the loss of PES back in 2019. If any of this maintenance, especially in the Northeast, goes long, look for distillates to be impacted. We haven't seen a high level of imports coming in. And with refinery maintenance happening at Irving Oil up in New Brunswick, that certainly could spark a rally in the price for distillate. But I think gasoline demand, you know, we're looking a little bit bearish in terms of soft gasoline demand. So I wouldn't think the turnaround season would look too heavily, although, you know, refineries are going to have to produce gasoline to chase distillate yields. And that could inadvertently push down gasoline prices at the same time. So certainly something to keep an eye on.
And Patrick, how much higher are gas prices right now than they were before the pandemic? Because I think that's what a lot of people probably react to when they go to the local station and they top off the tank. It still feels higher to them than maybe it was not too long ago.
Yeah, absolutely. These are still above average prices. Americans still grimace when they drive by the gas station and see these high prices. And again, I think the Biden administration's been carefully watching this for that. They know Americans are sick and tired of high gas prices, but again, there's not much they can do about that. I do think that by the end of the year, the national average could decline 25 to 50 cents. And again, there's a lot of refinery maintenance concerns still there. We're still in the peak of hurricane season or moving just beyond it. So there's still some wild cards to be had. But I do think as these refinery issues move into the rear view, I do think there's going to be some solid downward pressure on gasoline prices. And again, going into November, but it's going to get ugly potentially next spring, especially when you throw in OPEC's production cuts. We could really see gasoline prices pinched next year going back up. If this refinery maintenance drags along, that could certainly tighten global inventories further.
All right, we will be watching closely. Patrick DeHaan, thank you so much. That was great insight. We appreciate it.
Thanks for having me.
And coming up, crypto on trial. A criminal trial against crypto star Sam Bankman-Fried begins tomorrow with jury selection. We'll break down the ins and outs of the case. That's next. Footwear brand Birkenstock seeking a valuation of up to $9.2 billion ahead of its initial public offering. This coming as another test for the IPO market after showing signs of some fatigue in September. So this one hits home, Julie. As you know, big Birkenstock guy, wear them all year round. I'm one of those guys who wears them with socks because you know what? It's comfortable.
Are you telling the truth right now?
I'm absolutely telling the truth. I wouldn't lie
I've
about
never seen
that.
you in a pair of Birkenstocks.
Very comfortable.
You don't wear them. He's not wearing them. Spoiler alert for those who can't see his feet. He is not wearing them with his suit. He is wearing fancy shoes.
I will if you
I'm
want.
wearing sneakers, just so it's in the interest of transparency. But yeah, yes, I also am a Birkenstock wearer when I'm not.
You rock the socks? That's always the big test.
I don't usually rock the socks.
I understand. Yeah.
I'm really curious how the bankers are going to play this one, because what we're talking about here is 10.75 million shares at $44 to $49 a piece. The reports are that we could see the pricing after the close on October 10th, and then maybe for it to start trading on October 11th. That has not yet been confirmed here. And that's new shares, by the way, that 10.75. The question is, are they going to price it at the top of the range?
Yeah, that has been the move.
Which has not been,
Yeah.
it's been the move.
It has.
But it's not necessarily been a great move if you're judging by both the first day action, but also the ensuing action. So then do you have the bankers and the owners come in and say, maybe we want to soft pedal it a little bit and get more upside? I guess it depends on how much they want to collect right away versus how sustained an investment they want it to be.
Also, of course, we raised the question, does this trickle of deals turn into more of a stream and a flood at some point? We did talk to Byron Dieter, well-known, well-respected venture investor with Bessemer out there in Silicon Valley. His take to Yahoo Finance was he does think the pipeline is building, slowly building. He doesn't think that happens, for example, toward the end of the year now. He would be looking like late Q1 through June, Byron thinks, that it gets more active. But even then, he says, by more active, he doesn't mean we're back to like 2021. Right. He just means off these anemic levels we're seeing now.
Right.
Yep.
It's all relative.
We'll see. All right. A criminal trial for crypto superstar Sam Bankman-Fried kicks off tomorrow in New York City. The 31-year-old faces 7 counts of fraud and conspiracy in connection to the collapse of his crypto platform, FTX. Prosecutors alleging Bankman-Fried stole billions of dollars of customer funds to prop up his languishing crypto hedge fund, Alameda Research, and that he defrauded investors by covering up that scheme. He has pleaded not guilty to all 7 charges. Jury selection beginning tomorrow, and the trial is expected to last up to 6 weeks. For more on this, we turn to former federal prosecutor Adam Kamenstein. Adam's a partner at Adams, Dirk, and Kamenstein. Adam, thank you for being here.
My pleasure. Thank you for having me.
And Adam, you've been following this very closely. First and foremost, I just want to ask you, how strong do you think the government's case is here? And how many years potentially could Sam Bankman-Fried be looking at in prison?
I think the government has a very strong case here. It's got tens of thousands of pages of records that include texts, emails, financial transactions. I mean, that's one thing about these kinds of cases that involve securities fraud, bank fraud, is that you have the financial transactions, you can follow the money. And then on top of that, you've got 3 very high-level cooperators that have agreed to testify against Bankman-Fried. The government's got, I would say from the outside, what looks like a slam dunk kind of a case. In terms of the amount of time that Bankman-Fried faces, he faces under the statutes up to 110 years. That's, of course, not how courts actually fashion sentences. They use something called the sentencing guidelines. They look at the specific characteristics of the case and the defendant in fashioning an appropriate sentence. All that being said, I would expect Judge Kaplan, if Bankman-Fried is ultimately convicted, to impose an extremely long period of incarceration. We're talking decades. This is, after all, one of the biggest fraud schemes in history. So I think 30, 40 years potentially at a minimum.
Adam, I sort of have a related process question here because, for those of us in the financial media, it would be surprising if someone had not at least heard of this case, right? Is it going to be tough for them to do jury selection to find people who have not made up their minds about SBF yet?
Yeah, I don't think it will be that challenging. It's not disqualifying if the person's heard of this case. What you ultimately care about is that they haven't heard enough, or really what matters is that they haven't formed an opinion that's going to infect their impartiality. So, if they have some kind of passing familiarity with the case, that's not going to be disqualifying. It's going to be, from both sides, you're going to be looking more at the characteristics of the potential juror. and how they would view the facts, then you're going to be concerned about whether or not they have, some sort of passing familiarity. For sure, you're not going to select somebody that has a deep familiarity that's been following this, because that person's likely to have formed an opinion.
And Adam, I'm also interested in your take on why the average person should be interested in this case. I mean, obviously, those of us in the business press have followed this very closely, but are there reasons that our audience, traders, investors, business people, should also be following this closely?
Yeah, I think for one thing, crypto is becoming more and more ubiquitous, and it will continue to do so. So I think it's important to kind of have at least a passing or basic understanding of where the government is at in terms of regulating these crypto platforms and what your potential risk is with making deposits. I think also, regardless of what the government does or doesn't do from a regulatory perspective, this also just puts the average consumer on alert as to the questions that they might want to ask. I think this will also, of course, increase the diligence that more sophisticated and institutional type of lenders and depositors bring to bear. But crypto is it's the future. It's going to be as prevalent as your more traditional banks at some point in time. And so, kind of getting an understanding or appreciation.
Is it though, Adam? Is it though? Is that still the base case?
I mean, look, I guess folks could disagree, but I think digital currency is we're just seeing it at its most nascent stage. It's just the beginning. It's going to probably go through many permutations. It's going to have a regulatory overlay, but I think it's here to stay.
So when you talk about regulatory overlay, I'm curious about something else, which is that you get a fraud trial like this at the same time that you have this push-pull on regulation that's going on in Washington as well. From your time as a prosecutor, how much sort of interplay is there? In other words, how closely are regulators going to be watching this trial, and what lessons might they take away when it comes to writing the rules going forward?
Yeah, I think the big takeaway probably for regulators is going to be, what do they require of these crypto platforms in terms of messaging and communication to the consumer? What kind of advisements must they make in terms of risks? And then, of course, on the back end, there's going to be very clear and strict requirements in terms of what can be done with depositors' funds. So I think, on the front end, it's messaging and marketing to the consumer in terms of risks. And on the back end, it's enforcing them.
All right, Adam Kamenstein, thank you so much for your insight. We're going to be closely watching that trial. We know you will too. Thanks so much.
Thank you.
Coming up, Amazon's ad story. One analyst reveals why he thinks ads in Amazon Prime Video content will be a game changer. That's coming up after the break.
Time now for a check on the market action and take a closer look at mega cap stocks as Goldman Sachs adds NVIDIA to its October conviction list. Let's get Yahoo Finance's Jared Blickery with all the latest. Jared.
Thank you. We're going to go to Goldman in a second. First, I want to plot the chart action for some of these mega caps, including NVIDIA, on the Wi-Fi Interactive. And you'll notice here, look at all this green on the left-hand side of the Nasdaq 100 heat map. That is telling you all those big stocks are in the green. Very impressive given the surging dollar today and also the fact that the 10-year T-note yield has hit a 15-year high yet again. Over the longer term, you would expect that to weigh on some of these stocks, and they have, to be fair. We can see that they are down from their highs of varying degrees, but basically 3 to 12%, it looks like, from Apple, that's down 12.75%, to Alphabet, down about 4%. But let's change this back to some green, and I'm going to plot these guys in a second. First, I want to show you how the profit expectations have evolved for the coming year. And here you can see Wall Street raising their estimates for NVIDIA for the next fiscal year by 69%, Amazon 20%, Meta 14%, Alphabet 8%. So a heavy skew to the AI trade. The big question is, can the hype live up? Well, can the price action live up to the hype? That's something that has to be decided in the rearview mirror. But I'm going to chart each of these guys separately. And first, let's get to that Goldman note that I promised earlier. Just a couple of tidbits being added to the Goldman Sachs conviction list, as you said there, with the firm seeing strong long-term growth prospects for themselves. Now, here's a quote. Look for NVIDIA to maintain its status as the accelerated computing industry standard for the foreseeable future, giving its competitive mode and the urgency with which customers are developing and deploying increasingly complex AI models, also touting a strong and broadening demand profile in the data center. Now, this is an interesting stock over the last 3 months because it's basically treaded water. This high here, which is the all-time high, just short of 500, 499 was hit right after their earnings report, and you can see there's just been a bit of consolidation here. However, in context of the full year's price action, this is just a healthy sideways correction, and usually these things resolve to the upside. So probably a question of if not when, but that when is quite the I would say is quite the interesting one for NVIDIA investors. Here's Apple. I want to show you what's happened to Apple on a 3-month basis. This broke down below our support line here. Let's call that 170 to 175, and we are right back up. Sometimes when something is in the process of breaking down, it comes up and kisses that breakdown level and then proceeds down. That looks like what's happening now. We could shoot above it and create a false breakdown, but I'm really paying attention to Apple here because as Apple goes, so goes the rest of the Nasdaq, and for that matter, most of the stocks, guys.
Yes, good point and good rule. Thanks so much, Jared. Appreciate it. Well, turning to another tech giant, let's talk Amazon. It's looking to cash in on its new advertisement plan. The tech giant will start running ads in its Prime Video content early next year. A new note out from UBS says Amazon's move to incorporate ads could deliver over $6 billion in incremental revenue for Prime Video over time. Let's bring in the analyst behind that call, Lloyd Walmsley, UBS U.S. Internet analyst. Lloyd, it's good to see you. It's interesting because I feel like there was so much attention paid to Netflix when it introduced its ad tiers, not as much on Amazon. Why do you think that is? Is it just because it's a bigger, sort of more diversified company?
I think that's right. It's a much bigger company. They've got 2 huge businesses. People know and think of Amazon for the e-commerce business and the cloud business, and people just don't think of advertising and the Prime Video side of the business as something core to the actual business. And it hasn't been, right? They give away the video content as part of Prime, so it hasn't been, in our view, a huge driver of the business. It's been a huge investment area, and now they're finally starting to move that into harvest mode.
And Lloyd, what do we know about this initiative right now? I mean, when do the ads start? Which geographies?
Yeah, so Amazon put out a blog post last week talking about launching in early 2024 in the U.S. and several key markets in Western Europe. They've talked about France, Italy, Spain, Mexico, Australia, UK, Germany, and they've got strong viewership already. So what's interesting here is Netflix, which in disclosure is not a stock I cover, they have to migrate users from paid over to ad-supported or see new users come in and adopt ad-supported. In this case, Amazon will just start showing ads inside most users, unless they actually pay for a premium tier. Everyone will start to see ads, and so they're in a position to scale this very quickly.
And what role do you think Prime Video plays for Amazon? You know, again, it doesn't get the same sort of hype as some of the other streaming services, although we're showing some of my favorites like Fleabag in the video accompanying this chat. But, you know, does it, you know, sort of increase engagement, increase Prime membership, et cetera?
Yeah, so the historic lens that Amazon has viewed Prime Video through is, does adding this to the Prime drive new subs and or reduce churn in the core Prime business? And there's been, you know, the company's talked about it a little bit. There's been some interesting reporting out there on how they really dig in and analyze when they roll out a new piece of Prime content, what does it do in terms of driving new Prime signups? I think we've seen Prime, especially in markets like the US, Prime adoption has slowed quite a bit. You've seen it in their subscription revenue line. And so I think they're now at the point where they can start to move the needle more on actually directly monetizing this through ads. And so that, I think, is what's behind this move as they shift focus more broadly towards a sharper focus on profitability broadly.
And with ads, Lloyd, you know, you've crunched the numbers, I'm sure, for investors who are listening right now. What does it ultimately mean, bottom line? What could it mean for revenues and EPS?
Yeah, what we wrote in our report overnight, we think conservatively it could add $3 billion if they're just showing 3 minutes of ads every hour under the current, what we've heard from the advertising community is the current go-to-market. But if they actually increase those ads up closer to 6 minutes an hour, then it could obviously double that. You're talking about $6 billion of potential revenue coming in through ads. And by comparison, traditional linear TV is showing something like 16 minutes per hour of ads. Now, we don't think Amazon wants to take it anywhere near linear, but the point is they don't need to make a lot of money. And then the other thing that we talk about is the incremental margins on this are likely to be quite high for Amazon because in many cases they've already paid for the content. You know, they either own it outright or they've licensed it to basically provide it to Prime users. And so we don't think that there's a lot of incremental cost as they start to show ads and generate ad revenue in here. It's obviously very opaque. They don't talk a lot about how they structure any individual deals, and I'm sure a lot of them are very unique and different deal by deal. But I think in a broad context, we think that incremental margins here are quite high. So, you know, if they can get over time up to something like $6 billion at an 80% incremental margin, you're talking, you know, in the neighborhood of $5 billion of incremental operating profit to the company if we're right and they can scale this over the next few years.
Lloyd, just quickly here, I know this is sort of a big one to tack on the end, but I can't let you go without asking you about the FTC case against Amazon and sort of how you're modeling that. I know it's a long-term thing and you know, we don't know what the outcome's going to be, but just quickly, how are you sort of framing that in your thinking about Amazon?
Yeah, I think, like you said, it's a long-term headwind. It's likely to work its way through the courts for years. If you just look at the DOJ case against Google, the case was filed 3 years ago, and it's just now in court as we speak. So these things take a long time. One thing that we look at is what happened in the EU. The EU has already reached a settlement with Amazon around some of the complaints that the FTC is alleging in its case around pushing merchants to use FBA associated with Prime for the logistics side, and then asking merchants to stick to basically most favored nations type of clauses. And if you look at what's happened in Europe and when they've agreed to relax a lot of those restrictions, not a lot has really changed. Merchants still use a lot of FBA, and when we talk to merchants, they tell us it's actually a lot cheaper to use FBA for logistics than to go to a third-party third-party logistics company or use a UPS or FedEx. So I think it's, it's not just some of these conditions Amazon is putting on merchants that is driving their success. I think that's, maybe helps on the margin, but it's not the core driver of their success. And so honestly, I think it will take years for this to get resolved, but there's a pretty optimistic path where even if they agree, ultimately you're settled or forced into changing some of their business practices, it ends up not being a really big deal. And certainly in the scheme of what we think is a powerful margin improvement story, it's hard to see the results of this regulatory outcome being material relative to some of the other things going on at the company. At least that's our view.
Lloyd, thank you so much for that. You were generous with your time. We appreciate it. That was Lloyd Walmsley, UBS Internet Analyst.
Thank you.
Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
That was the closing bell on Wall Street. Let's do a quick check of the markets now, sponsored by Tasty Trade. We've got a lot of pink up there with Estee Lauder ringing the closing bell. So a little last-minute turnaround, it looks like, for the S&P 500. It had been trading lower, just eking out a very small gain of less than a point on the day as we settle out here. The Dow, though, still in the red, off by 74 points, that's about a fifth of 1%. And the Nasdaq higher by 2/3 of 1%. To end the session here. As we've been talking about utilities, energy, real estate, materials in the red today, we've got information technology and communication services, though, as evidenced by the strength of the Nasdaq, outperforming on the day. Let's also take a look at some of the movers that we are watching on the day. Shares of Discover Financial Services climbing after an agreement with the FDIC. In a filing, the credit card issuer disclosed agreeing to improve its customer compliance and related corporate governance. I believe at one point it was the best performer in the S&P 500, although gave up some of those gains at day's end. So basically, this is a consent decree with the FDIC in order to improve some of its customer and consumer interactions. According to analysts, they were concerned that there would be a more onerous remedy here in this case, and so that's why we're seeing a bit of a relief being expressed in the shares.
Yeah, exactly. So analysts apparently seeing it as a positive, no fines or penalties. In other words, regulatory overhang lifting here. For example, Wolf Research saying no smoking gun. And I think that pretty much sums up a lot of feelings from the traders and investors today.
Yeah, back in July, when the company said that this whole back and forth was going on with the FDIC, a couple of other things were weighing on the stock. It said basically that it had done a review after some incorrectly classified credit card accounts from around mid-2007. That was unrelated to the FDIC decree, but still, that was something weighing on the shares. At the same time, it also paused its share repurchases. So we'll see if we get a restart now that this portion has been resolved.
And moving on, GameStop shares remain under pressure, sliding in today's trading session, hitting its lowest level this year. Company last week, remember, named Ryan Cohen as CEO amid the company's turnaround push. And you remember, Julie, I think we discussed some analysts, including our friend Michael Pachter, Wedbush, not fans of that move.
No, not fans of that move, but it looks like shareholders, interestingly, are not necessarily fans of that move either. And this is a switch, right? For the period of time in which GameStop could sort of do no wrong, no matter what, people outside the company might have been saying about it. And that has definitely changed. And sentiment has indeed soured on GameStop. It's interesting that, the sort of slip in the company, I think it's probably a coincidence, but the release of Dumb Money, the movie that sort of examined the meme stock craze coincides with this drop in the shares of GameStop. Maybe people taking another look at the stock. Who knows? As we see this switch over.
$15, by the way, 15 at 1.480.
Yeah, I remember.
You remember those days?
I do remember those days. It wasn't that long ago, interestingly. There's the longer-term chart. And let's take a look at NextEra Energy Partners. It's hit with a downgrade over at Wells Fargo. The stock cut to equal weight from overweight. The bank also slashing its price targets. Shares of parent company NextEra Energy also sliding in today's trading session. Now, I think this is a really interesting story because last week, NextEra, the parent company, cut its targets, got a bunch of downgrades. This is just the latest sixth day that we've seen declines for these companies here. And basically, NextEra Energy cut the growth goal for NextEra Energy Partners. And that's what started this whole slide here. The worst performer, NextEra Energy, that is, in the S&P 500 on the day.
Yeah, and I think you'd be in, the broader question of these higher interest rates as they begin to pose these headwinds, these challenges for the wind stocks, right? The solar stocks, the clean energy stocks. You begin as a trader investor to wonder, okay, where's the next shoe dropping?
Well, and it's not just the renewable energy stocks, it's the traditional utility companies as well. If you take a look inside the Yahoo Finance Interactive, looking at the sectors on the day, utilities, in part led by NextEra, down the most in the S&P 500, energy stocks as well. But the XLU, that's that ETF that tracks those, down by more than 4.5%. And traditionally, there are a number of reasons that higher interest rates weigh on power companies. They tend to have high debt loads, right? And so they're paying higher energy servicing costs. They also have relatively high dividend yields. And so when treasury yields creep up and up and up, that provides some competition. If I can buy a treasury that's seen as a very safe return versus a utility, you see some yield competition in that case.
Might not be the last headline we see like this.
Yeah, we'll have to keep an eye on it. XLU down 11% over the past 5 sessions.
Wow.
Yeah.
All right, we are moving on. Commercial real estate is about to crash. That is according to a new survey of investors by Bloomberg. The rise in remote working, high rates, and the collapse of regional banks causing the street to predict a severe collapse and at least 9 more months of declines. Assam Naji is the president and CEO of the commercial estate firm Marcus and Milchap, and he joins us now. Thank you for joining us. Listen, Assam, you saw that headline. You've seen those. It's just a recent tough headline we've seen to the sector, but I'm interested as, a guy who's on the ground there doing the work. What are you seeing for this sector?
Good afternoon. Thanks for having me on the program. I think there's a lot of generalization going on. Commercial real estate consists of a lot of different subsectors, which includes apartment properties, self-storage properties, hotels. If you think about it, warehouses, as well as office buildings, of course, retail, shopping centers, and more of the fast food restaurants and single tenant type of retail. It is a very diverse and expansive industry. And office buildings, of course, have the most visibility and get the most attention. And they are under a lot of pressure because of the lack of return to work and the hybrid workforce now being very much in the camp of fewer days in the office and lower office space demand. But the generalization is hitting all of commercial real estate unduly. The data just doesn't support it. And it's hitting the banking sector concerns unduly as well, in that the bank's exposure to office buildings is fairly limited.
So, Assam, it's Julie here. It's good to see you again. So let's just zero in on offices then, shall we? Because according to the survey that we cited, investors are looking for another perhaps as long as 9-month slide and a bottoming out in office prices before we could see some sort of recovery within that sector. Does that timeline sort of make sense to you?
Yeah, great to see you again. It does, in the sense that the office sector has a whole different cycle moving through than, let's say, apartments or shopping centers and other property types. In that we're seeing older, obsolete buildings suffer the most from the lack of demand. Quality assets, if you look at the most recent vintage, let's say built in the last 10 years, those vacancy rates are around 11% nationwide, and the overall office vacancy rate is pushing about 20%. So the newer, higher quality buildings are performing much better. Even within office, the generalization is very dangerous. And as I was saying a minute ago, the exposure that banks have in the banking system breaks down as follows. Of total outstanding loans held by US banks, 24% is in all of commercial real estate, And of that 24%, 15% is in office buildings. As I mentioned, within office buildings, the newer ones are performing just fine. The older ones are having some trouble, for sure. We're seeing prices decline. We're seeing some distressed sales. The interest rate shock that the Fed has delivered to all of commercial real estate and banks pulling back from lending because of these sort of cautionary notes and concerns about commercial real estate is affecting the whole industry. And we're going through a pricing adjustment right now. But it's really concentrated in older office buildings.
So even if we're just talking about a percentage, right, and it's not huge, I mean, what you're looking at potentially is sort of a freeze in the industry, right? If you're looking at these higher interest rates, if you're looking at pricing that is not moving enough to get new buyers interested in some of these older properties you're talking about, you know, what are the implications for the banks that do hold this stuff? That, you know, are they going to have to write down the values of it? Looks like they're not going to be able to refinance right now, except at much higher rates. What's sort of the outcome then for those who do hold these properties?
The predominant strategy that we're seeing in the marketplace, as suggested by the Treasury and by the Federal Reserve, is for banks to work with those owners, borrowers, as much as possible to extend the current loans, modify the terms. But there are some of the stock of office buildings that are just not going to come back. And I think that's where we're going to see some distressed sales. We're actually seeing some of them already. In general, there is a tendency to cooperate and avoid write-downs and avoid the significant sort of, if you will, domino effect that could happen from too many distressed properties being sold at the same time. Again, I want to emphasize, we're not seeing the level of distress at all in a multifamily, in even shopping centers, hospitality. All of those sectors have recovered very well since the pandemic. So this is, again, concentrated predominantly in the office sector.
And there, the price adjustments you are seeing, though, Hassan, when do you think you would expect those prices to bottom? Would that be a second half of next year? Is it 2025? I ask because, you know, I would assume a lot of buyers, they don't want to step in unless they think you're close to a bottom.
You know, we're going through the classic time period of owners expecting pricing from 6 months ago or a year ago because they've held their assets for a while. Maybe they have some equity built into the property. Most of them do, and the operations are fine. And therefore, their price expectations have not adjusted to the interest rate shock that we're absorbing in the industry. I mean, you know, 500 basis point plus movement on interest rates in 17 or 18 months is truly a shock to the industry, compounded by the banking concerns and the banks pulling back from lending. So you're absolutely right in that there's a logjam in the market. Buyers want a higher discount. Sellers aren't ready yet to capitulate. But on an asset-by-asset, market-by-market basis, we are seeing those price adjustments. And any asset that's coming in the market 15, 20% below the 2022 peak is getting multiple offers because there's plenty of liquidity and cash on the sideline. It's just a price realignment that just takes time. I think your forecast of another year or so on the office side of the equation is reasonable, in my opinion, and based on what we're tracking. In all the other property types, that adjustment is happening as we speak. And I think the market is going to start moving a little bit quicker on the other segments of commercial real estate.
When you look very specifically at cities like San Francisco or even some office areas here in New York City, now that we've, you know, been back, quote unquote, to the office, some of us more so than others, for a year plus, are there sort of permanent changes you foresee in office real estate, either the way the buildings are used, the way the offices are constructed, the pricing of offices, now with the benefit of having some time to have seen this all percolate through the system?
We absolutely are seeing that. First of all, the average days in the office is very gradually moving up. It's still below 50% in some of those urban markets. Even less. And so you're absolutely right. That is creating a big concern about future demand. I believe the lowering of footprint for office space usage is permanent. It's structural. The pandemic really created a modified mindset around being in the office full time. I don't think we'll ever go back fully, but I think we're going to go much closer to it than where we are today. I think it'll continue to gradually improve because people just need to congregate. They need to be with their colleagues and supervisors, and in time we'll get closer, and we're not going to go back all the way. So we have to assume overall office space demand has been lowered by somewhere around 10 or 15%. The good news is we haven't been building a lot of office buildings, and it's a question of what do you do with the obsolete assets? They're not as easy to knock down or replace as shopping centers were when e-commerce hit. And that's why retail is far ahead of this curve. It's actually coming back from the e-commerce impact over the last 10 years as people go back to entertainment-based retail and experiential shopping and so on. Office buildings are going to be harder to reimagine. The reuse to residential is something we're seeing, but then extremely limited and very costly. So I'm afraid the more obsolete and older assets are going to take the brunt of the hit when it comes to values, and that'll really come out in the next 12 to 18 months.
Sam Naji, thank you so much for your time today and that helpful insight.
Thanks for having me on.
And coming up, former President Trump on trial. The former president and his sons, Eric and Don Jr., are on trial after being accused of persistent fraud in order to help boost Trump's net worth. How will the trial impact Trump's presidential campaign? We'll break it all down next.
Current GOP frontrunner Donald Trump is in the spotlight today. The former president and his sons, Eric and Don Jr., are on trial in New York City after being accused of persistent fraud in order to help boost Trump's net worth. Yahoo Finance's Rick Newman has more on this story, which is, as we know, one of a host of legal troubles for the former president, Rick.
Right. Trump is facing prosecution in 4 criminal trials, and this is not one of them. This is a 5th legal case. This is a civil matter, people may recall during Trump's presidency, there were a number of exposés by the New York Times and others of how Trump dramatically undervalued his properties for purposes of tax payments, but then sometimes overvalued them for other reasons, such as to use as collateral to get bigger bank loans than he might have otherwise been able to get, and also to inflate his overall net worth, which is very important to him. So what was anybody supposed to do about it? The decision by prosecutors here in New York was to file this civil criminal case against Trump. So the prosecutor, who is New York State Attorney General Letitia James, she's asking for a $250 million fine, and she also wants to basically ban certain Trump business activities in the state of New York, revoke his operating certificates, if you will. So that's what this is all about. Trump is not going to go to jail, no matter what the outcome here, but it could cost him a lot of money and affect his businesses directly.
Right, and his whole, or not his whole, but one of his sort of selling points, if you will, has been his prowess as a businessman. But, you know, if it's found that he's not worth that much, does that do anything to that sort of reason for people to support him?
Oh, sure. I'm guessing all the Trump supporters will immediately vacate and move over to some other candidate.
Okay, so it was a silly question, Rick. Sorry.
I'm being cynical. Of course not. Nothing sticks to Trump. Nobody's exactly sure why, but Trump's base, which is a significant portion of Republican voters, they're sticking with him no matter what. I mean, they like whatever he stands for and whatever he represents to them, and they don't care about prosecutions involving possible illegal activity, whether he lied about his businesses, whether he's not as good a business person as he always claimed to be. And some of this is not a secret. I mean, Trump has had 6 business bankruptcies in his illustrious business career, and that didn't bother anybody. And that was a known fact all the way back in 2016. So Trump just has a lock. He has a Vulcan mind meld on the Trump base within the Republican Party, and it's hard to see anything changing that.
Indeed. Rick Newman, thanks so much. Appreciate it.
Hi, guys.
Want to get you caught up on where we closed out the markets today. We were talking about, and this is sponsored by Tasty Trade, we were talking about the squeaker that the S&P 500 had today, which is a 1/3 of a point increase on the day. The Dow, though, did not make it into the green. It finished down by 74 points, and the Nasdaq up by 2/3%. I've been taking a look at some of the best performers in the S&P 500 today. We talked about some of them earlier, including Discover Financial and some of the large cap tech stocks, the likes of Alphabet. Insulet is not one that you may be familiar with. POD is the ticker there. It got an upgrade today over at Jefferies. This is a company that makes insulin pumps. And the analyst at Jefferies saying that the potential of GLP-1 weight loss drugs like Wegovy, for example, will only have a modest or no drag on the opportunity for insulin pumps. That was a note that caught my eye, Josh.
And shares of Kellogg ending the trading day down after the 117-year-old maker of Pringles and Frosted Flakes split into 2 companies. Snack side of the business with brands like Pringles and Pop-Tarts will operate under the Kellanova company, ticker K, while the cereals like Fruit Loops and Special K will operate under the name WK Kellogg Company, ticker KLG. Yahoo Finance's very own Brian Sazi got a chance to speak to Kellanova CEO Steve Cahillane earlier today. He discussed this new era for the company. Let's take a listen.
If you think about our business, starting today, we're now 80% snacks and emerging markets. We're led by 5 iconic brands, your own Pringles being the biggest brand, Cheez-It, Pop-Tarts, Rice Krispies Treats, Eggos. These are all brands that are growing very, very nicely. They're all highly differentiated. They're iconic. We have a very exciting international business. 30% of our business is in emerging markets, countries like Nigeria, where we have a tremendous competitive advantage, countries like Brazil. So a very exciting new era for us. It's really about growth. It's about growth for our share owners. It's about growth for our people. It's the next chapter.
Talk to us about the work to get to this point, the human component. Where are people staffed? What do the manufacturing facilities look like?
Yeah, so we still have a huge manufacturing footprint all around the world, a number of plants here in the United States, number of plants really everywhere we do business. We're very local. We have local supply chains, so plants all through Latin America, plants all through Asia. I'm actually heading to Thailand in a couple of weeks to do a groundbreaking for a new Pringles facility in Thailand. We're adding a Pringles facility in Mexico. We're full in Jackson, Tennessee with a Pringles plant. So a manufacturing footprint that spans the globe.
Why break up a company like this?
We really think that the best way forward for our cereal business, our North American cereal business, is for them to be a dedicated team focused on North American cereal with their own strategy, their own balance sheet, their own access to capital. So that's what we've done today. KLG starts trading today as an independent, North American focused cereal business. And we think the markets will appreciate that. We also think they'll appreciate the Kellanova story for what it is. I mean, we love the Kellogg history, obviously. When people say they work for Kellogg, immediately they're greeted with a smile, but they're also greeted with, oh, you're the giant cereal company. And Kellanova is something very, very different. Still cereal internationally, but really, as I said, a snacking-led business with brands like Pringles and Cheez-It and Pop-Tarts that will really now shine through.
Is this about unlocking value? And I asked that because I remember you were also the one that sold, Keebler's? That came under your watch too. So you've been making a lot of changes to this company. Is this about ultimately just extracting the value in an iconic company like this?
It's about shaping the portfolio so that we're really aligned where the best growth opportunities are. So when we sold some of the Keebler assets, so think about the cookies, pie cones, crust, fruit snacks businesses, they were third and fourth share positions. They were not growing, and we really didn't see a competitive advantage in our ownership. We found an owner that really likes those brands, that would invest in them in ways that we wouldn't, because our best investment opportunities are some of those big 5 brands that I mentioned, as well as our emerging markets, our international businesses. So it is about unlocking growth, and it's about capturing that growth and that value for our share owners.
You've mentioned what appears to be a big push into Pringles. Is that how you're coming out here blasting as a public company, focusing on expanding Pringles around the world?
Yeah, Pringles can be found virtually everywhere in the world, and we're unlocking the growth through this additional capacity that I mentioned, because we're really selling everything that we can make. We're at capacity. So continuing to drive our international business and the business here in North America. But equally, Cheez-It was always just a North American brand until just 3 years ago. We launched it in Canada. Now we've launched it in Brazil, and this year we launched in Mexico. Next year we'll be launching in Europe. So Cheez-It, we're only scratching the surface for what that brand can do.
Some of the early analyst coverage on the company says we're unsure if some of these brands like a Cheez-It, Pringles, they have more growth left to them. What does your innovation pipeline look like?
Our innovation pipeline is robust. I mean, if you think about where we've been since the pandemic, it's been about getting your product through the supply chain and onto shelves, your core brands. There was no room in the factories really for innovative new products because it was about getting your fill rates to where they need to be. We're now really back to where we were, even stronger than pre-pandemic. So our 2024 pipeline for all of our big brands is robust, stronger than it's ever been.
There's been deal activity popping up here in the snacks business. Smarker picked up Hostess. Are you viewing Kellanova as a platform to make deals?
Yeah, our organic opportunities, as I already mentioned, are fantastic. And so as we think about our capital allocation, we'll be growing organically with those new greenfield sites that I mentioned, but our balance sheet is very strong. We paid down debt all through the pandemic. We have a leverage ratio below 3, about 2.8. And so we've got dry powder for the right acquisitions. We'll be disciplined buyers because, again, we compare inorganic opportunities with the great organic opportunities we have. But we'll be active. We'll be looking.
A lot of debate in this country about inflation. Where is it? Where is it headed? How do you see it in your business?
Yeah, so if you think about the last 18 to 24 months, it's been unprecedented. We haven't seen this level of input cost inflation. We've taken 30% price in the last 2 years. That's like taking 2 decades worth.
Steve, that's huge.
It's huge. And so as we stare into 2024, luckily, we're not looking at that same input cost inflation. There's obviously commodities that are up. There's equally commodities that are down. Wages are up. We think that's a good thing. That's sticky. But we're looking at a more benign environment in 2024. We'll have the wraparound benefits of pricing that we took last year, this year, first quarter and second quarter. But as we look at next year, we're looking at a much better balance between volume and price.
Before I let you go, we've talked for a number of years, and I don't often really get to talk to an executive doing a transaction like this, iconic company, over 117 years old, about that. How has this weighed on you personally? I can't imagine this is something you have taken lightly. I can't imagine you've slept a lot over the past 18 months.
No, thank you for the question. It's been humbling for me because you don't take something like this lightly. It's such an iconic company. I'm privileged to stand on the shoulders of giants who came before me. And so I really thank my team because together, we've created this new vision for the company. 18 months of work like I've never seen before. My leadership team is the best I've had the privilege to serve with, and they've brought us through to this day in a way that is just very, very inspiring to me personally.
I'm not sold on wearing a mustache. I'm just not going to be that guy. I appreciate the effort here, but I used to have one in high school. I can't go back to it. Steve Kaline, CEO of Kellanova. I almost said Kellogg, but Kellanova. Good to see you.
Great. Thanks for having me, Brian.
A growing number of retirees have stepped off the sidelines and they've headed back to work, especially after many were forced to retire in the pandemic. That's according to a new report from T. Rowe Price. The report found that around 20% of retirees say they're working part-time or full-time. 7% are looking for work in retirement. Yahoo Finance senior columnist Carrie Hannon here to discuss what's behind this trend of unretiring. Carrie, I imagine it has a lot to do with the economic backdrop.
Well, it does, in fact. There's kind of a combination of factors here. Half of the people who have unretired have done so for financial reasons. They simply need the money. The other factor, the other group, about 50%, they're doing it for positive aging reasons. So let's look at the financial piece first. People often there are quite a few retirees who took early retirement packages during the pandemic. And now they're finding that inflation has been eroding their savings. They're fearful about living their money, and they really feel like they need to get back on the job. A couple of trends that have emerged from the pandemic make this possible in a way that it never did before. There is remote work opportunities and contract jobs, both things that just took off during the pandemic and make it possible for workers who have, quote, unretired to have some flexibility in how they go about working again. So when we look at that financial piece, let me tell you, there are some wonderful reasons to continue to work in some fashion, even if you have saved appropriately, because you can maybe add to retirement accounts. You can, stave off dipping into those retirement accounts so they can keep growing. And you can delay your Social Security benefit possibly from full retirement age, say 66, 67, until age 70, and you get a 8% increase each year in your benefit that is permanent between those years, full retirement age and 70. This can be significant. So those are really strong financial reasons. for the reasons for healthy aging, what's wonderful there, it gives people a purpose. It's a reason to get up in the morning, a reason to network and have a social group. It sort of fights back against loneliness. And it also is use it or lose it. You know, it's that mental acuity that comes from continuing to work. So these are some of the main, really positive trends that we see of people unretiring. So it's not necessarily a bad thing, but I think it is what we are definitely seeing a movement toward. And I would expect moving forward, we'll see more unretirees because, in fact, people who retired for health reasons, the ability to remotely work makes it easier to stay on the job. And I think that's something that's really quite noteworthy.
And Carrie, for the people who are nearing retirement, how can they prepare for what's to come, especially if work in some fashion might be part of their next chapter?
Yeah, I absolutely love that. A lot of people think about what they're retiring from. They know they're retiring from that job, but they're not thinking about what they're retiring to. So they haven't actually done that soul searching about, why do I want to work? What do I want this chapter of my life to look like? And if I want to work, how much money do I need to make? What am I thinking about here? Once you can figure that out, it makes you more nimble about what kind of work you might want to look for. And there's certain steps you should take. Think about what you might want to do, but you might need to add some skills. You might need to do that networking and talk to people doing the kinds of jobs that you might want to do. And you need to think about this in a way. You may even go boomerang back to your old employer and say, is there a way that I can be a consultant for you, or, any of those sorts of things. But it's reaching out and maybe even moonlighting, doing the job first. But what people have to hang on to is you're not replicating the job you did before. This chapter of work in your life of unretirement is really something that's like a patchwork quilt. You might do something for a couple of years and switch to something else. You might do it part-time. You might do a couple things at the same time. So you kind of have to get out of that linear mindset of what your career was prior to this and what work as an unretiree can be.
Carrie Hannon, thank you so much. We appreciate it.
Thank you.
Since the pandemic, expectations of work have changed. Where and how people work and how success is measured is now different. According to a new study from HP, the research that looked into the lives of business leaders and staff found that globally, 27% of white-collar workers have an unhealthy relationship with work. And 4 in 5 people are willing to earn less to work somewhere that prioritizes greater fulfillment and flexibility. The New York Times bestselling author and psychotherapist Lori Gottlieb worked on the study and joins us now. Lori, let me start with this stat, which surprised me, that 27%, just 27% of workers say they have a healthy relationship with work. That doesn't sound good. I guess my first question was, Lori, how are you defining healthy here? How did you define that term?
Yeah, that's such an important question because as a therapist, so many people come in and they talk about relationships. And one of the relationships that they do talk about is work. So with this HP Work Relationship Index, we're really learning what I'm already seeing in the therapy room, which is that a healthy relationship with work means a lot of things, including expectations that have changed, especially over the last 2 to 3 years. So a lot of people want to have more flexibility with work. They want to be more trusted with work in terms of how they manage their productivity. They want more connection at work. Many people are feeling disengaged, disconnected. So I think what people are saying is, I have different expectations than I did before, and I can be a better worker if these expectations are met.
Lori, it's Julie here. I guess the other question I would have is, how much of the root of their unhappiness is things that they can control versus things that stem from work itself? In other words, can they go in and approach work differently? Can they have different conversations with their managers, et cetera, to sort of shift how they feel about work?
Yes, absolutely. So a lot of people are afraid to go talk to their managers. And I think that the way that people can do it is to start slowly and to think about the way in which they ask. So instead of saying, you know what, I'd really like to work from home, you might say, what if we tried having me work from home one day, and let's try that for a month and see whether I'm more productive that way. And a lot of people will agree to that because it's a trial and you're just experimenting with it. And I think the other thing, too, is to focus on, what does this offer your employer? So if I work from home, I'm actually able to do more, and here's why. And, there might even be little things. So employers don't realize sometimes, and I think this is where expectations have changed too. People are saying, I need to take care of my wellness. So if I need to go to a dentist appointment, if I need to go to a doctor's appointment, I want to have the flexibility to make that happen. So it's about the whole culture at work and really looking at how can I make sure that there's wellness incorporated into what we're doing here. Some companies are bringing in yoga, meditation, even having just a quiet room where people can go if they're kind of in an open office. That can really help people to kind of focus on not only their productivity, but their mental health. And I think what people don't realize is that when people are feeling better, when their mental health is taken care of, when they're not so drained that they can't see friends or family, when they aren't so drained that all they're thinking about is work, you're actually going to get more out of them.
And Lori, as a therapist, I'm interested to get your take. When people aren't feeling good at work like this, what kind of toll does that take on them, both, mentally and physically?
Well, that's the issue, is that we're not just thinking about work when we're at work, we're thinking about it when we're outside of work too. And that's why in the HP Work Relationships Index, they found that 83% of people would be willing to earn less in order to be happier at work. Because when you're happier at work, you're happier outside of work. So this means that when you're happier at work, you have more balance. You have the ability to make connections. We've talked about this loneliness epidemic. So people make more connections with friends and family when they're not thinking about work all the time. And when they have the flexibility to make those connections, they can exercise, they eat better, they take better care of themselves. So these are all important aspects of how do we show up at work based on what we do outside of work.
Lori, how much do employers care about this stuff? And I should say, how much do they really care about it versus how much they say they care about it?
I think that they both care about it and say they care about it. I think both are true. I think with these new expectations, people started to say, listen, I know change is hard, but I think we're realizing that if we don't change, we're going to lose the most talented people, and we really need them. We want them. And I think that they're realizing also that they need to be more curious. So if you look at the HP Work Relationship Index, the managers are saying we need to be more emotionally intelligent. We need more emotionally intelligent leadership. And I think that it's both sides coming together. It's people asking for what are reasonable expectations, and it's people on the other side saying, I'm open to hearing those, and I'm open to offering them, and even I'm open to starting the discussion.
Psychotherapist Lori Gottlieb. Thanks so much, Lori. Appreciate it.
Oh, my pleasure.
Up next, we'll go around the horn with some of today's top stories, including reaction to Taylor Swift's NFL Stadium tour. That's next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Madison Mills. Madison, welcome to the roundtable.
Thank you. I'm so excited to be here.
And I know you have one story in particular that you're looking at, and it's one that we talk about a lot, and it focuses on AI.
Yeah, Jamie Dimon is predicting that we're going to go down to a 3.5-day work week. So obviously I clicked on that the second I saw it today. He isn't saying that he wants a 3.5-day work week. He's saying that AI is going to make so much of our workplace more efficient that we're going to be able to decrease the amount of days we're going into work to 5 days. He also said that kids are not going to die of cancer anymore because of AI technology. So putting a lot of faith in AI there. He said that thousands of JP Morgan employees are using it. They use it for equity hedging. So the question I have, though, is are we going to see a shortened work week coincide with job loss related to AI? Is that going to be the thing that we see finally kind of making this labor market get a little bit tighter in the years to come?
I would say probably. I feel like it's just this cycle when you have new technology and you have new ways to increase
laptops stole your job too, right?
Exactly.
At some point, we're talking about tools that eventually probably overall help the economy become more productive, right? That's sort of the bonus part of the argument that's being made here is we're actually going to be able to produce more because say we didn't work 3.5 days and we worked 5 days with the AI engine. That's what some of the economists that are predicting the economy to grow so much more because of AI are bringing up. And it does remind you of the early 2000s internet laptop argument of, well, computers are going to do your job for you. But if you know how to use the computer
to help
you, then it actually can just make you a better worker. And I think that there's obviously two sides to the argument here, but I think if you're able to do that, there's been research that says some of the people, even in lower income jobs right now, are actually going to benefit from it because AI can help you make you better, basically, and replace deficiencies that you have in your role and make you a better worker.
Yeah, and I think there's a lot of doom and gloom that always surrounds AI and how they're going to steal your job. And even Jamie Dimon said, yes, if you get this technology in the wrong hands with the bad people, bad things are going to happen, but there are a lot of positives. And, you know, we see AI really every day in our lives. I don't even think everyone's aware of how much data we give up and how often we're on our phones, our tablets, our computers. Technology is all around us, and that's only been getting better and better. What does that mean in the long run? There's going to be changes, there's going to be disruption, but that could be a positive thing.
3.5-day work week doesn't sound like a bad.
That sounds nice to me.
At a high level, I'll take a 3.5-day work week if they're going to give it to me.
Right? You just got back from vacation. I'm sure you're excited about the idea.
Yes, I just got back from a long 2-week vacation, and if I came back to 3.5 days as opposed to 5, I feel like that transition would be a lot easier.
I have an idea for your next vacation.
Okay.
You gotta go to the Las Vegas Sphere. Did you guys see this video this week?
It's great.
U2 premiering in the Las Vegas Sphere. So the Sphere just had its first concert. This was, of course, the giant bubble in Vegas that went viral over the summer. They had an eyeball on it that was blinking, and a lot of people were very concerned about that. It looked a little creepy. But this is what the Sphere is actually made for. So this is a break-off of part of Madison Square Garden Entertainment. They created this company, Sphere Entertainment, in a spin-off. The stock was up about 15% today. And the overall pitch here, what James Dolan has said they want to do with the Sphere is create this and franchise it. So you have this kind of experience with the Sphere. You can see they spent over $2 billion to build this thing.
Yeah.
But they want that video immersive concert experience to be what we want out of concerts. Put a couple of these throughout the country, put a couple throughout the world, and sort of change concert venues because their opinion is NFL stadiums are pretty boring. Why is Taylor Swift going to an NFL stadium?
I wouldn't say NFL stadiums are boring, but I do see.
Depends on the game.
It depends on the game.
Well,
It depends on the game, but we were joking earlier that we're going to see people watching the Super Bowl inside of the Sphere someday. I could see weddings going, like you could just, the sky is the limit for something like this, I feel like. Jared was flagging earlier that advertisements for one day on the Sphere for the kind of outside effect, $450,000 for one day. So a lot of potential revenue associated with this.
Yeah, this reminds me of the Soarin' ride in Disney World, if anyone's ever been on that. But that 3D, 4D experience, and we're seeing live events come back with such a vengeance, and it's really helping to boost the economy. That's what consumers are spending their money on, is these live event experiences. And if you have something like that, where you could literally be transported to a different place, a different time, have this totally immersive experience. We already have this AR, VR technology coming out as well. It makes perfect sense why this comes at this point in time.
Well, I was saying to Maddie off air earlier, It kind of reminds me of the Oculus, right? Or the Quest from Meta. Like, it's a very similar concept.
Except you don't have to put something on.
No, you're actually there.
Yeah.
But it makes it feel like you're in there, even when we were talking about the prospect of watching a sports game in there.
Yeah.
If they could make it look good, so you kind of feel like you're on the field and you're behind the quarterback, like you can see how that adds up into a totally different experience that you actually do want to go see. I was just surprised too. Wall Street analysts coming out today and saying how impressed they were with the experience. Those are not people that are always easily impressed by just flashy things.
Yeah.
So for some of the analysts on the street to go and say, you know, I actually really think this is legit, it stuck out to me.
Well, you brought up football games, and there was a very important football game on Sunday night. I tuned in because Taylor Swift came again for her second game, Chiefs versus Jets. We got the numbers in, official from NBC, and they peaked at more than 29 million viewers, average 27 plus million viewers with 53% viewership among teen girls compared to the season to date average. And you know those girls are coming to see a little bit of Taylor. She had her entourage there, Blake Lively, Ryan Reynolds, Hugh Jackman. But to me, guys, what really stuck out is how heavily the NFL is just leaning on this. There was a whole Carson Daly voice explainer about how football works through Taylor Swift songs and who Travis Kelce is.
That was so cheesy.
It was very cheesy. Look at it. The NFL literally had this on their social media. I mean,
when you start pandering to social media is when you no longer have control of the moment. You have the moment when you have something going on and social media is reacting to it and sort of building off of it. It feels like the NFL is now trying to serve social media a little bit. And I just wonder if they're a little bit past it. How many weeks in a row are people going to tune in for this? I don't know. I doubted the Barbie movie.
It was all over my feed.
I doubted the Barbie movie and I doubted the Taylor Swift concert tour too. So I'm probably wrong.
No.
I get the excitement. I just wonder how many weeks you're going to see sky-high viewership and things like that, like actual benefits to the league from it.
But as we've been talking about, why would the NFL not try to capitalize on this?
Perfect sense.
You know what I mean?
Yes.
Every single brand could benefit from Taylor. Even we saw Heinz offering the seemingly ranch product because
she was eating a chicken finger
with potentially ranch, right? So of course they're going to try. And I love the idea that this summer has taught brands to market to women and girls a little bit more. And I feel like this is just the latest example to that. There's half the population out there that they could be selling football to.
Well, that's exactly right. You're bringing in a whole new audience to the NFL, which already has millions of viewers every single week. And now you have people that don't necessarily know much about football. And I'm a Eagles fan, so I like the other Kelce.
Where Taylor's from.
Nice. Yeah, so I actually am curious to see that game. Kelce versus Kelce, Eagles versus Chiefs. Taylor, I mean, what are you going to do? Where do your allegiances truly lie?
The last point I wanted to point out too is just the jersey sales, because you can see how Travis Kelce is sort of benefiting from this in some way too, but clearly there's new fans that just want to root for him. Like they're excited about Travis Kelce, the character, for his jersey sales to be up 400% and him to go into the top 5. Travis Kelce's been a good NFL player for a long time now. So these are clearly Taylor Swift fans that are getting excited.
And did you see some of the jerseys? They were spelling Kelce wrong.
Yeah.
Oh no.
So, I mean, they need to get the official jersey.
Yeah, they got to get the official
There's
jersey.
still more that the Swifties need to learn, and there's still more that you guys need to learn. And coming up on the other side of this break, we have much more Yahoo Finance. Stay tuned.
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Microsoft CEO Satya Nadella taking a stand in the Google antitrust trial. He testified that Google used unfair tactics to harm Microsoft's Bing search engine. Nadella saying Google's default agreement with Apple cemented the browser's dominance and that the idea there is choice for users is, quote, bogus. Oddity Technology reporting preliminary third quarter results. The parent company of Il Makiage and Spoiled Child makeup and skincare brands sees revenue growth of 29 to 31%. That's above previous guidance. Oddity says repeat sales helped drive the results, although it didn't release specific numbers. The company started trading in July at $35 a share. The shares were up in after-hours trading, but not quite to that IPO price. And finally, General Motors furloughing more workers amid the broader UAW strike. The automakers indefinitely laying off 160 more workers at plants in Indiana and Ohio because of the impact of the strike on some facilities. The union was set to hold another round of negotiations with GM and Stellantis on Monday.
And here's what to watch on Tuesday. In the morning, we'll be getting the latest JOLTS report. The Street is predicting we'll see a slight increase to 8.9 million openings. And it comes ahead of course, the government jobs report on Friday. Criminal trial of former FTX CEO Sam Bankman-Fried will begin with jury selection getting underway. He's facing 7 counts of fraud and conspiracy in connection to the collapse of FTX. He has pled not guilty to all of the charges. Evergrande is looking to have its shares resume trading tomorrow in Hong Kong. Shares of the property developer were suspended as the news broke that its founder was being investigated over suspected illegal crimes. Evergrande says all documents have now been disclosed. And closer to home, President Joe Biden's son Hunter is set to be arraigned on 3 criminal charges stemming from a gun he purchased in 2018. He's expected to appear virtually and to enter a plea of not guilty. After the bell, both McCormick and Cal-Maine Foods will report earnings. And finally, October 3rd is officially Mean Girls Day in reference to the Lindsay Lohan movie. There's only one thing to do, wear pink.
Will you be celebrating?
Do you want me to wear pink? Is that what you're saying?
Maybe? I don't know.
I'm game.
I could wear, I guess.
Maybe I pink Birkenstocks. Yeah.
Oh, I like that. All right, that'll do it for today's Yahoo Finance Live. Come back tomorrow at 3 p.m. to see if Josh is wearing pink. Have a great day.